A young couple sits in a quiet office, finishing the final paperwork for their first home. After years of saving for a down payment, they finally sign on the dotted line. 3 days later, they log into their bank portal. A balance of $500,000 is sitting in their account, ready to be wired to the seller. Where did that $500,000 actually come from? Did the bank wait for another customer to deposit the same amount? Was there a physical stack of $100 bills sitting in a vault? Most of us are taught this model. We view banks as high-security piggy banks, middlemen taking money from extra savings and lending it to homebuyers. But the vault is not where this money starts. To fund this loan, the bank didn't move a single cent out of anyone else's account. When the couple signed that contract, the bank didn't just transfer existing wealth, it expanded the total amount of money in the economy by $500,000. In our modern system, a bank creates money through accounting. When a loan is approved, an officer simply presses a key, typing a new balance into the borrower's digital ledger. Think of a small-town tavern where the owner is trusted by everyone. You want a drink but have no cash, so the owner writes a $5 IOU on a coaster and hands it to you. Because the owner is reliable, you can trade that coaster to another patron for a sandwich. Within that tavern, that coaster, that record of debt, is now functioning as money. Commercial banks do this on a global scale. They aren't handing out gold or paper. They are issuing digital IOUs that the entire world has agreed to treat as currency. A bank loan is an exchange of promises. You promise to pay the bank back in the future, and in return, the bank gives you a brand new digital credit you can spend today. If this sounds like the system is creating something for nothing, there is a reason it doesn't run entirely uncontrolled. Banks are bound by strict legal limits. They are required to hold a specific amount of their own capital as a safety net, and they must constantly assess whether a borrower can actually fulfill their promise to pay. We allow this because it serves as the fuel for economic growth. Without this constant creation of new credit, the gears of the modern world would grind to a halt. These digital entries are what allow a contractor to buy lumber, a scientist to fund a lab, and manufacturers to build factories. It turns future potential into immediate action. Virtually every major project in our modern landscape exists because a bank agreed to record a new debt into a digital ledger. This power to create money is a massive responsibility. If banks lend too freely, the system begins to overheat. When too many new digital dollars chase a limited supply of food, fuel, and cars, the value of every dollar drops. This is how excessive lending leads directly to inflation. If new money funnels into real estate, it pushes housing prices to levels disconnected from reality. When borrowers can no longer pay, the cycle reverses. The digital money vanishes, causing a sharp contraction that leaves the economy paralyzed. This reveals a fundamental tension. The process that funds a generation of homeowners is the same process that can trigger a deep financial crisis when the math no longer adds up. To prevent this collapse, every country has a bank for banks. These are central banks, and they sit at the top of the financial pyramid. They act as the system's thermostat. By raising interest rates, they make it more expensive for commercial banks to issue those digital IOUs, effectively slowing down the creation of new money. The balance in your checking account is a living record of this process, a complex architecture of credit and trust that keeps the global economy moving. But if banks can generate money with a few keystrokes, why don't the world's wealthiest people keep their fortunes in cash? The ultra-wealthy understand that in a system built on debt, cash is often the worst place to hide. That is the subject of our next documentary.